What is going on, guys? It's your favorite mortgage lender, Abdel Khawatmi, Got Mortgages. Happy Wednesday. So we're coming in a little late later today, but I wanted to kind of really dive in heavily in regards to the agenda for today. We're going to go over what are the common loan types that are out there. Okay, so many different things are happening within the market right now in terms of interest rates, in terms of a lot of different various changes. We're going to go over what are the most common loan types that are out there specifically that we offer within our team and alongside what realistically is out there for any consumer. The first thing we go over the five main mortgage types that are out there. You have a fixed mortgage, right? And there's two different types of fixed mortgages that you can acquire, right? You can have a conventional mortgage, which is usually the most common, and then you could simultaneously also have an FHA mortgage. Lizette, what up? You could have a jumbo loan, a collateral loan, which is a DSCR loan, also known as, and then adjustable rate mortgages as well, right? Now, a lot of the other different types, I have a 203K loan that we're going through right now, actually, with one of our partnered brokers. Super smooth, bids in, appraisals in. We went through all the different various sources. We were able to push the file through. We've got some portfolio loans as well that we individually portfolio or have other lending investors who will go through. A lot of our terms can vary from 10-year, 20-year, 30-year, whatever the terms may be. And then, of course, when we talk about choosing the right mortgage program, the most important thing that I want us to think about, there are four different types of programs that we're able to acquire. Okay. And the first thing that we look at is your credit score, right? Where is your credit score at? What is your eligibility in terms of qualification? And then the next thing we look at is your capacity to repay the loan. Do you have the necessary money and funds needed in order to close? Thereafter, we look at the capital. Where's your money coming from? And then we take a look at the collateral. What are you looking to buy? So we'll dive right into it. The first program that is out there is a conventional mortgage. By far, the most common mortgage program that consumers are generally taking advantage of. Okay. DTI requirements are usually up to 49%. Okay. Credit scores are generally at a minimum 700 and above is needed. I've had a few where we've gotten them done a little over or a little under that, but generally the sweet spot is 700 from what I generally see. And then again, you can have a down payment. You can put as low as 3% down, or you can put 5% down. So what's the difference? 3% down will give you accessibility to being able to put obviously only that amount and be under what's called a home ready program, meaning you can't make more than 80% of the area median income. And then on the other side, if you don't want to have any income restrictions, 5% down would be the minimum requirement. And that 5% down obviously would not have any restrictions when it comes to income. Okay. Now, we always talk about mortgage insurance, of course. Mortgage insurance on a conventional loan, as many of us are aware, if you put 20% down, you don't have it. Now, I have a deal right now. Fingers crossed, we're trying to close it tomorrow so they can wrap up by the 30th of next week. Client originally went 20% down. We did a little bit of what I call a switcheroo behind the scenes, and I dropped it to 15% down with upfront mortgage insurance. The client is only paying $47 a month for mortgage insurance. It is I think it was like a $600,000 home. So upfront, he's saving roughly anywhere from $25,000 to $30,000 upfront from that down payment of 15 to 20 and actually getting, in my opinion, a much better deal. Payment was a little bit higher, but he's saving $30,000 up front. And then we have an FHA loan. Again, another very common program, as most of us always hear about, right? Federal Housing Administration generally take advantage of with your first-time home buyers, right? You can have a credit score as low as 580. 620, of course, is the necessary sweet spot where you don't need any exceptions simultaneously. Mortgage insurance is always going to be mandatory on an FHA loan if a consumer is putting less than 1% down. So that's important for us to look at. It must always be owner occupied. A client must always live there. And we spoke briefly about 203K loans, which is the rehab loans. That is generally where the client has the ability to finance the repairs, right? And then we dive into the next one, a VA loan. These are probably one of my favorite. VA also stands for Veteran Affairs. These are the loans that people have the ability to be able to acquire. If they're in the military, you can sometimes in some instances have more than one VA loan, all depending on if you have what's called remaining entitlement. We just closed one about 3 weeks ago. At the start of the new year. and it was a VA borrower selling a property in Colorado, moving to Jersey, and we were able to simultaneously close. So how long does the question in the comments, how long does a person have to live in a property if they had an FHA loan? So generally the rule of thumb is you have to move into the property within 60 days and then generally live in the property for a minimum of 1 year before you look to purchase another owner occupied home. Okay. Now there's always sometimes exceptions. And I've run into these where basically we can get, let's say your family gets bigger from when you bought it to simultaneously when you obviously acquired the property. That's a motivation. So let's say the place is just too small and you want to move into something bigger, right? Let's say, or if you're in a multi and you want to move into a single, it's a little easier for a letter of motivation for us to get around. If you're trying to go from a single to a multi, very, very difficult for you to be able to take advantage of those options as well, right? So I hope that answers your question. Now, VA is really, really similar too, where they have restrictions in regards to how long you have to live in the property. They have restrictions in regards to how quickly you have to move into the property as well. Okay, so the taxes on VA borrowers can simultaneously be waived. And then there's two different things that we need to get, which is the DD 214. And then also simultaneously, we need to be able to obtain what's called the certification of eligibility. That's called the COE. Certificate of eligibility is going to simultaneously give the consumer the opportunity to find out what their entitlement is, and then be able to take it from there. So very, very important for us to be able to look at those options and take it from there. Now, the next thing that we have is a USDA loan. So now, if you're in North Jersey, the reality of you getting a USDA loan is probably slim to none. It is very what's called property eligibility restricted. And the best way for you to do it is be able to go here, and you guys can simply Google property eligibility USDA. You'll be able to pull that up. Now, of course, your realtor and mortgage professional should be able to also have access to this right away. But let's say, for example, if I search my office and we tried to pull it, it's going to tell me the property is not eligible. So it is not located in an eligible area. Therefore, we are not able to obtain a USDA loan. Now, another thing that I want us to know about USDA loan is there's something called area median income. So you are not allowed to make more than 115% of the area median income. So again, if we search my office, 1 Main Street in Eatontown, and we go down to what the area median income is in that specific area, we are not allowed to have more than 115%. So where's this thing at? There it is. So 116,000 is the area median income, which means that we would go 116,300 times 115%, which means that a consumer is not allowed to make more than 133,000. If he makes more than 133,000, they are not able, or she's not able to get it. They would have to go alternatively with a conventional or FHA loan. Okay. So that's the main things in regards to that. Of course, you have the benefit of 0% down, but you have to meet those restrictions. Now, we talk about a jumbo loan. A jumbo loan generally, luckily in New Jersey, we have a lot of areas that are what's called high cost areas. And right now in 2024, high cost can go as high as 1.1 million, which means that you can actually move into a property more or less with a standard conventional loan, being able to put as low as 5% down, subject to your qualification, and be able to still qualify, right? Which is crazy. I remember at one point where it was, I think it was 2019, believe the jumbo loan limit was just under 428. So like 428,000, 450,000. We're now almost close to double that, right? And we're constantly creeping up as home values appreciate. Obviously, that's going to go up as well, right? So what happens is with a jumbo loan is, let's say you're in Mercer County as one of the areas where 766 is the max. You would have to go jumbo and meet certain parameters, such as 10% down. You would have to also make sure you had minimum credit score restrictions. Or usually, I mean, there's a few that's like 680 and above, but you truly want to be at that sweet spot, 700 and above. and then have access to the reserves, and then obviously access to the stricter credit parameters as well, right? Um, so that's a lot on the traditional side. Now, the most important thing is what I'm seeing is what's called non-QM mortgages, non-qualified mortgages. So non-qualified mortgages is the first one, a DSCR loan, which many of us have heard. We've seen a lot of people jump online recently and talk about them. We're actually doing them. DSCR is a debt service coverage ratio loan. That is where we take the potential rental value of the property, and that financial metric has to cover the mortgage payment. If it covers the mortgage payment, you're 100% in the clear, and it's covered the debt service coverage ratio, which means that if you could rent the property out for $3,000 and your mortgage payment is less than $3,000, you're now 100% in the clear and you have the ability to qualify. Generally, the minimum down payment on that at minimum is 20% down. Sometimes if you're doing a cash out or anything like that, it's 25% down. So 75 loan to value would be the max. Okay. Again, the benefit of this loan predominantly, if the property does cash flow, it is essentially a no doc loan. We don't need your income or assets or anything of that nature. The credit does play a factor. We don't need anything else in terms of standard income qualification. Bank statement loans. So this has been a new one that I've been really, really dabbling with heavily and getting a lot of clients approved. I actually just got one on a refi for a partner of ours, 3 different properties. We're pulling cash out of all 3 properties, supplementing it with the bank statement income and supplementing it with the rental income in an effort to get the client to qualify for the cash outs. So we take the bank statement income. It's basically stated income. We add all the deposits that's coming from the bank statements, and then we would simultaneously just hit the consumer with a 20% expense ratio. They hit the 20% expense ratio. That's the income that we use. 80% of the total deposits from that individual business deposit. A 1099 loan. So this is a cool one too. We'll take the gross 1099. So that one piece of paper, 1099, and we'll be able to take that qualification and be able to qualify a borrower and actually only hit them with a 10% expense ratio. Okay. We have another one called a P&L loan, profit and loss loan. That is another one where if you're self-employed, generally a realtor or mortgage professional or anything like that, this is a great tool and a great avenue for being able to show your income and of the actual profit and loss. So we're going to get your bank statements, your financials. We're going to add that up. We're going to put it on a P&L sheet. And we're going to be able to do the calculation from there and figure out in terms of your qualification. Okay. The next one is DPA loans. So I personally have within my individual branch 2 direct loan officers that we have that handle all of our in-house DPA programs. Okay. And basically in the state of New Jersey, it's usually 10,000, 15,000, or 22,000 now with a little bit of a boost they're giving with the $7,000. So this DPA, again, it's a down payment. It's a 5-year interest-free program. If you live in the property for at least 5 years, the 5th year and the day after, 100% is gone. Okay. We're doing a lot of these right now. We're taking advantage of them. We have the ability to close them fairly quickly, and we're obviously approved with all the necessary accreditations that you need to. And then the other program that we'll have is an ARM mortgage. I started doing a little bit more of these than I generally used to before. Obviously, with a little bit of fluctuation in the market, we know simultaneously that interest rates are kind of being a little stubborn right now. We'll kind of dive into that last to kind of see where all the interest rate items have been going and then truly taking it from there, right? And then the last stuff I wanted to talk about and diving into the last item was talking about home prices and home appreciation. So home prices, guys, if you take a look at this graph, it literally breaks it down from basically 1941 to current where home values have appreciated. And it is pretty crazy to see that home prices have jumped up from 1943 to 1947, almost 118%. You guys see this 11, 17, 12, 24, and 21. We're on a pretty similar trend since 2020 was 10, 2021 was 19, 2022 was 6. Last year, according to CoreLogic and the FHFA, we're at anywhere from roughly 7% to 9%. And really, let's say even conservatively 7%, which means that if you bought a home within literally the last 4 years, you would have appreciated in value 4, 10, 19, 7, 40%. You would have appreciated in terms of your home values and your home appreciation. And that's truly on a conservative level. Anybody here who's bought a house in my opinion, the tri-state or Jersey, we're seeing an even higher uptick in that. Okay. So going back to that, because that's so crucial, home prices constantly seeing that appreciation level is very critical for us when we're explaining things to our clients. We like to go over that and truly make sure that they get the understanding that when home prices, they're in no way, shape, or form. It is simple economic 101, supply demand. And what we're starting to see at the same time is that any drop in terms of interest rates, home values are skyrocketing. And we've been seeing that. Rates are kind of sort of being a little stubborn right now, guys. And I'm going to show this and then we'll wrap up exactly what we've been kind of teetering with over the last few couple of days. As of today, again, they took a little bit of a turn. We had a little bit of some green at one point. I think it was Monday. That's when we locked about 7 clients on Monday for our team. But we saw a little bit of a downtick, which was Monday on the 22nd. And then we've been seeing a little bit of an uptick recently. Okay. So it really kind of depends. Remember, when we're looking at interest rates, the most important factors that I want us to think about is the client's credit score, the client's down payment, the client's loan to value, and what they're purchasing, right? What are rates today, Abdel? I mean, it really depends because we locked one borrower on an investment property 7.5, which was really freaking good. And then we locked a owner-occupied borrower, I believe it was yesterday, at a 6.99, actually getting back $1,100. So really, really varies in terms of that. But if we were kind of to see, they're kind of teetering. In my opinion, I usually tell my clients right now, if you're getting a conventional mortgage, you should be anywhere from 6.75 to 7.25. And then if you're getting a government loan, you should be really closer anywhere from, I would say, 6.25 to 6.75, specifically within that window, right? Now, if you are interested, and I'm talking these without paying points, if you are interested in paying points, we locked one borrower VA loan, which again, I told you guys I do a lot of. A VA loan, we locked the borrower at a 5.875 paying 1 point, okay? And all of my VA borrowers, personally, I always give them employee pricing, giving them the hyper competitive rates there is, and at the same time with the exact same level of program and services, okay? So keep that in mind, okay, guys? So any questions that you guys have, please feel free to let me know, and then hopefully we'll have the ability to kind of consistently still see this appreciation that we're seeing and really go over things truly, okay? So if you guys have any questions whatsoever, please feel free to visit our website, gotmortgages.com. Vanessa, I appreciate the kind words, and I look forward to chatting with you guys soon. I will always download these and share it on our YouTube channel. So any questions that you guys have, let me know. Let's rock and roll. Have a great night.